Over the last week in the S&P 500, we see a lot of big names that are down, the likes of Meta, Google, Eli Lilly, Nvidia, some of these even in fact down double digits, where we can see a lot of rotation into other underloved companies. And in fact, that trend has continued today. Other than Nvidia, which has recovered around 2%, we are seeing that continued trend of tech companies, of communication sectors like Google, down continuously. One of the reasons for this, as we already mentioned, is there is starting to be some rotation out of the big tech. Now, the main question is, will that continue? Will we see this rotation over the next few weeks? Or is this the dip that should be bought? Now, today's episode, we're going to take a look at some of these that have been hidden over the last week to see whether or not they are a great opportunity to buy now. The first one, Alphabet, as we can see over the last 5 days, they are in fact down 5%, and over the last 52 weeks, they do still trade towards the upper end of the 52-week range. We do get a double buy rating with a hold from Quant, and it is one of the cheapest right now in the Mag 7 alongside Meta, which we will cover in terms of a forward P, just below 24. Now, they also recently introduced a dividend, and on a trailing 12-month basis, it does sit at 0.11%. Now, over the last year, still very, very admirable performance, up 43%. Over the last 10 years, as we can see, outperformed the S&P, up 494%. Now, when we take a look at this into our valuation model, we get to an intrinsic value of $188. Now, bear in mind, in terms of these episodes, we do run through every single one of these models. We discuss our inputs and outputs. Today, jumping straight in, we also note Wall Street do have some very nice upside, 24%. Their price target does in fact sit at $220. Now, what we'd like to do here is apply a margin of safety, and as always, we do put a 10% MOS to start off with. Wide moat, strong financial metrics, good forward-looking data. If it does hit that, then we do believe it is attractive at this level, which would be 169 for Alphabet, though as we can see, it isn't at that level yet. So in today's episode, we see around a 5% margin of safety. But as always, do let us know your thoughts as we go along. Some of these companies, you may be warranted in buying them at a premium or in fact near their intrinsic value. We then move on to Costco Corporation, which is a buy from Wall Street with a double hold from the other analysts. Over the last month, they are down around 4%, but we can see over the last year, very strong upward trend, 54%, and over the last 10 years, significant outperformance of the S&P, plus 700%. They have cooled down, although marginally, from their all-time highs around $900, but still trading in the upper end of the 52-week range. As we can see as well, they do have a forward yield 0.55%, but a fairly hefty valuation at 53 on a forward P basis. In terms of Costco, well, we have reviewed it not too long ago, and our intrinsic value at $823 isn't actually too far off the current trading price. Now, even in today's episode, we don't see that 5% MOS. It would be around $782, but for those that do think that this is a company that should be bought at a premium or in fact near its intrinsic value, then it could be considered one for the portfolio. We also note Wall Street do see some upside, though it is fairly limited, 4% at $867. Remember, these are the price targets for over the next year. We then move on to Amazon, where we get a strong buy from Wall Street, a buy from Seeking Alpha with a hold from Quant. They are trading in the upper end of the 52-week range, although we do note they're down 2% today and nearly 6% just over the last few days. Now, over the last 12 months, while still up 38%, and over the last 10 years, more than 1,000%, and they currently have a forward P of around 41.22, and the first one today that doesn't quite yet pay a dividend. Now, in terms of the valuation, $185, which we do pretty much see the current value today, so this is one that we see trading at a fair value, but Wall Street are in complete disagreement. They see upside of 21%. Their price target is $222. As we saw the first strong buy rating, they are very bullish on this company. As always though, do let us know your thoughts below, and if we were to look at a margin of safety of 10%, you would need to wait for around $166. Just to let you know as well, we have released our latest free weekly article. If you want access to this or any other articles, it is completely free. You do get instant access by clicking below, and we have just released one of our articles that does come with a free spreadsheet. So if you want to see all of the undervalued dividend kings, what our buy price and estimations are, do go ahead and grab that while you can. Next one we're looking at is Meta. Now they're actually up around 3% today, but we can see still over the last few days they are down around 5%. Over the last 12 months, up 53%, and over the last 10 years, up 530. As we can see, they were trading as low as around $90 around 2 years ago. Now, they are essentially trading at the upper end of the 52-week range. We get a double buy with a hold from Quant. Also a yield, although very, very marginal, and one of those that did introduce it not too long ago. In fact, they are the cheapest company in the Mag 7 on a forward P valuation, just under 23, pretty much in line with the S&P 500. So in terms of Meta and the valuation, our intrinsic value of $567 does give a margin of safety of 10% at a minimum up to 510 at 15%, not too far off the current trading price. So it doesn't have a 20% MOS level yet, sitting somewhere between 15 and 20%, with per Wall Street and their targets around 13% upside. $534 is their price target for the next 12 months. We then move on to Nvidia, where we see that strong buy rating from Wall Street and a double hold from the others, trading towards the upper end of the 52-week range. Very trivial yield of 0.03%, forward P just above 43, and over the last year we can see up 160%. Over the last 10 years, phenomenal performance, 27,000%. Now when we take a look at the valuation, our intrinsic value, $140, does indicate that there is a nice margin of safety, 10% up to 126, and whilst it isn't at that 15% level, it is pretty much a dollar short, so you could argue a 15% MOS, with Wall Street indicating 18% upside, $141.50 as their ultimate price target for the next year. This then does lead us to Eli Lilly and Company with a double buy and that hold from Quant. They are down 11% over the last few days, but when you zoom out over the last year, they have got an incredible run, up 90%. Over the last 10 years, phenomenal 1,233%. Now, as we said, they are trading towards the upper end of the 52-week range, a yield of 0.57%, and a forward P, again, does look very pricey at 66, so you could possibly argue we are anticipating a much larger pullback than the 6% that we have seen just today. In terms of the valuation as well, our intrinsic value is much lower, $784, than not just the current price, but also Wall Street and their forecast. And for us to get at least a 10% margin of safety for this company, we would be looking at around $706. Now, as always, different investors will be looking at different things when they come to their investment thesis. 5%, 10%, or as we said, even at its intrinsic value, may be one that you would be looking for. And for those that don't like volatility, want a bit more security, you could look at an S&P 500 ETF like SPY, where we do see an expense ratio of 0.09%. We get a buy rating from Quant, a hold from Seeking Alpha, and again, it is trading towards the upper end. It does pretty much follow in line with the S&P 500, and over the last year, up 23%. Over the last 10 years, up 180%. As we can see, Eli Lilly, Alphabet, Meta, Amazon, and Nvidia. As always though, do let us know your thoughts below. Some people will prefer ETFs for the security. Some people will like to buy some of these stocks we've covered on more of a significant dip. Or maybe some of these are fairly attractive at these prices. Now, as always though, do let us know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and we'll see you all on the next one.